Good morning. Welcome at 8 a.m., and thank you for those of you who joined us early in the morning after Method Man and Red Man. I think we were joking in the back. This session is brought to you by Women in ETFs, and Women in ETFs is affectionately known as WE. And just looking at the crowd, I think we were right when we were saying perhaps this session should have been titled, We Have a Hangover, because it's a little, I think we'll have some more people rolling in, but appreciate those of you who are here and are powering through. My name's Allison Bonds. I lead the intermediary sales teams at State Street Global Advisors SPDR ETFs, and I am thrilled to be joined by my esteemed panelists here. I'm going to actually let them introduce themselves, but I think what you'll find here is that we have quite a variety of industry leaders within the ETF industry from a variety of different firms. And I think today's conversation around unlocking ETFs, specifically with these three providers represented, is going to give you some real insights about the last 30 years of ETFs. So why don't I start to my direct left with Cleo.
Good morning. Thank you for all coming, early risers. My name's Cleo Chang. I'm from American Century and Avantis Investors. So we entered the ETF space about 5 years ago, and I've been really impressed by the innovation and the adoption across all client channels in the ETF world. In particular, we're really excited to see the growing adoption of institutional clients and institutional consultants finally recognizing the role ETF can play in their portfolio. So we're really excited to be on this journey.
Yes, good morning, everyone. Thank you for showing up. I also see a bunch of smiles. I was not expecting that, but so appreciate it. Work for Allianz Investment Management and spearheaded the team that developed the ETF business for the company a few years back. My background is really from the asset management side. I've been overseeing a franchise, a $35 billion multi-asset franchise. I've been building sub-advised portfolios with a bunch of different asset managers out there, and also help the institutional investors allocate their assets. So right now I'm focused mostly on strategic partnerships on the ETF side and building out the franchise that we built for Allianz Investment Management.
I'm Jill DeBerardinis. I'm delighted to be here with all of you early in the morning. I am a divisional sales leader at Vanguard. At Vanguard, we cover our RIA clients, about 15,000 RIAs around the country. And my team works with them from the perspective of investments, portfolio construction, business and practice management, and we work with them on other business issues that are facing RIAs today. As you can imagine, the topic of the future of ETFs is a big one for us and something we're spending a ton of time on.
Perfect. Well, it is quite appropriate that we are having this conversation this year because we are celebrating the 30th anniversary of the launch of the original exchange-traded fund, SPY, which was brought to market back in 1993. And it's unbelievable to see over the last 3 decades, how the ETF industry has grown, and really how a single idea of innovation can create so many better incomes for investors. I'm going to sort of kick it off, and Cleo, maybe we'll start with you. Given that we are celebrating 30 years of ETFs, and today we have this $10 trillion ETF industry globally, there's over 10,000 exchange-traded funds across the globe. I sort of think that sort of begs the question, what client segments are driving that growth? And I think that here in the United States, sometimes we have a perception that it's a lot of financial advisors, a lot of RIAs and other financial advisors, perhaps a lot of retail investors, but maybe not as many institutions. So is that a misperception? How are you seeing the different client segments drive demand? And does it differ whether we're talking about the United States or other areas across the globe?
Thank you, Allison. That's a great question. And I think if there's one word we have all come to appreciate about ETFs and started with SPY 30 years ago is this industry is evolving every day, every week, every month, every quarter. So I would say in the United States, the market has largely been driven by RIAs and to some degree retail investors. Institutional usage of ETF has been more focused on just getting hedges or specific beta exposure. But since 5 years ago, as more and more active ETFs has made it to the market, I think we have definitely started to catch attentions of institutional clients and institutional consultants. I know for a fact because my team and I were out there talking to institutional consultants almost every week, answering very, very specific questions about how they can think about using active ETF in their portfolio. And I think so starting with SPY, with all the product innovations over the last 30 years for all the providers in this industry, we have really moved the goalpost further where it can benefit clients through every single segment. Europe and Asia, if you look at the available data, I do think there's a larger percentage of ETF assets being held by institutional clients. So we think this is probably a global trend we're going to see. But we need to continue to serve the original client base, right? The RIAs, the retail clients, because they have driven so much of the innovation, and we cannot lose our sight on helping that segment to do better through more innovative products.
So I think that's really interesting, like hearing an active perspective from American Century. And Jill, I've got to bring you in from the passive point of view. Are you seeing anything differently as it relates to use cases of ETFs and maybe specifically around institutional uses of ETFs?
Yeah, absolutely. So it's kind of interesting. I think of ETFs as, these days we think of them as mainly a retail vehicle. That's the end user is really a retail person. But the original use cases for ETFs really were for the institutional audience. And so it's important to kind of think about where the benefits of ETFs play a huge role for institutions. A couple of things. From a broad-based perspective, as far as portfolios are concerned, we still see most of the institutional exposure here at Vanguard on those broad-based, very transparent products that are so quintessential to our lineup. But we're starting to see more interest in, just as Cleo was saying, we're starting to see more interest in some of the actively managed spaces. For us specifically, that's been a lot around factor-based investing and some of the factor strategies that we offer that are actively managed, where we're starting to see institutions take a different approach and want to include factors in those portfolios. If you guys ever want to think about use cases for institutional ETF usage, one of the places where I've gained a ton of knowledge about it is really from Eric Balchunas. He's a friend of Vanguard who works at Bloomberg Intelligence, and he wrote a book called The Institutional ETF Toolkit, and he laid out 13 different ways that institutions could be using ETFs. And it was a pretty comprehensive look. So we're seeing fascinating ways that they're being used these days, including people are lending out the ETFs, doing securities lending on them. They're using them for doing manager switches when they're working with active managers that are going to switch in and out of a portfolio that Johan had mentioned earlier, and a numerous other group of use cases.
Perfect. And then maybe, Cleo, I'll just come back to you. I think one of the interesting things that we've seen recently in the ETF industry is some headlines around institutions actually partnering with exchange-traded fund providers, providing seed capital to launch exchange-traded funds, a specific type of strategy that they're looking for. I think the most recent example in the headlines, there was a Finland-based insurance company that partnered with BlackRock to the tune of $3 billion to launch 2 climate-focused ETFs. And so, Cleo, is this something you're observing, and what would you say about its implications on the industry?
Yeah, I think there are many of these type of conversations going on. I don't think every single one of them gets the headline that BlackRock got, but I would say from our own experience, we're having those conversations every week. So, just from our limited perspective, it's a real trend, and there's so much interest from the institutional clients to get into the active space, but they also want to be involved in the strategy design phase of these products. So we all know, like, launching an ETF is not hard part. It's getting traction into those products. So having an institutional client to serve as an anchor investor in an ETF is one of the best things that can happen to any ETF provider. So I think that's real. I think the other thing we're really focused on when we talk to institutional clients is how does an ETF offer you almost all of the benefit and attributes you want to have in a separate managed account without having to do all the legwork to necessarily set up your own separate account. And I think once you put that out on a side-by-side table, and their eyes just lit up. So I think that's And then another reason, where a pooled vehicle like mutual fund historically really wasn't the ideal vehicle for large institutional clients, because one investor's action to go in and out of the fund ultimately affected the long-term investors in that pooled vehicle, whereas in the exchange-traded fund wrapper, you don't have that problem. And that was the biggest hurdle, having come from the institutional side of the business myself. That was always one of the biggest hurdles of us using pooled vehicles. The fact that exchange-traded fund almost completely negate that deficiency in that pooled vehicle structure has opened eyes for so many on the institutional side, and we're so excited to be in this space at this time.
Wonderful. Well, I think that was a great overview of the growth of the ETF industry, specifically which client segments are driving it and how institutions are using ETFs. But Johan, I want to bring you in, and on the topic of things that are gaining traction, there is a new category of ETFs that certainly is, and it's really these exchange-traded funds that target a defined outcome. Sometimes they're called buffered ETFs, defined outcome ETFs. And I think in order to explain them, we have to just spend a minute talking about some regulatory changes that have occurred, that have actually, potentially opened up or sort of cleared the way for this new category of ETFs. And specifically, over the last few years, the SEC has implemented the ETF rule and the derivatives rule. And so maybe can you just take a second before we talk about defined outcome ETFs, but take a second and talk about those two regulations, what the heck happened and how they have kind of created this pathway.
Yeah, I appreciate that. I think every now and then the SEC gets it right. And the cluster that was before the ETF rule was, 300 plus filings specifically arguing for an ETF being launched by an asset manager. Tedious process, expensive, time consuming. Didn't really allow for, fruitful and quickly implemented innovation in the space. So between that and the derivatives rule, it's opened up the playing field for people. So it's a more of an even playing field as it relates to coming to market. And frankly, it's been stimulating innovation, and you've seen that, especially on the active side. When you don't have to go beg for something from the SEC, you can just do it based on a new set of parameters that are very well articulated by the SEC, easy to adhere to as long as you stay within the guidelines. You can launch an ETF pretty quickly, and that's part of what we've been talking about as well. You have this rule change that is completely revolutionary for the industry, and you've seen it with big players. Now we see transfer of assets from the mutual fund space to the ETF space with conversions. You see a lot of small issuers coming to market because it's become less onerous and less expensive to actually put your strategy out there. You're giving the bigger providers, no offense, a little bit more of a run for their money. Like, they need to sharpen up their own toolkits a little bit too, right? Because now you have pressure in the economy, in the industry, I should say. The economy, that might be a little bit of a stretch. But so you have pressure on this now, and that's really healthy for the end user and the retail investor at the end of the day.
Okay, perfect overview. And speaking about this new category that has been unlocked, defined outcome ETFs, they've only been around for about 5 years. The first one was launched in the fall of 2018. Today, defined outcome ETFs have over 26 billion in assets under management. What I think is really interesting about them is that we've seen flows into these ETFs in different market environments. So last year, 2022, I think most people would agree that was an environment where you were trying to mitigate risk. So a buffered ETF, it's sort of no surprise that those brought in about 10 billion in assets last year. But this year's been different, right? This has been more of a risk-on year, and I couldn't help but notice that this year, defined outcome ETFs have brought in about 5.7 billion in assets year to date. So, Johan, can you talk a little bit about what are defined outcome or buffered ETFs? And if you're a financial advisor, what client is suitable for this? Who should be thinking about using these types of products and in what environment?
Yeah, it's a big, and full disclosure, this is what we do at Allianz. So I am talking our book, but also for the industry. It is highly relevant, so I appreciate the question, first of all. In terms of how these work, just a quick baseline, 30 seconds on this. You get exposure to an index. In our case, it's the S&P 500. And you can participate over a certain amount of time up to a certain limit. So if the limit or the cap of this ETF is 15%, and the market goes up by 30, you only get 15. You don't get the other 15. And what do you get for that in return is a buffer on the downside. It's either 10% or 20%. So if the market is down by 10% or less over a certain outcome period, you're still flat. Like you don't lose, you're buffered against those losses. So what we see is a lot of investors that are gravitating toward a 20% buffer because it's very rare that the market tanks by more than 20%. And if it's down by 21, you only lose 1. So that's kind of the trade-off. If it's down 30, you lose 10. So it's not like it's not a floored product by any means. And it's nothing new either. This has been around. It's a structured product. We build it using flex options in this case that are customized. You can be very specific with the outcome you're looking for. So we do all this in the background, right? At Allianz, we've been managing risk for many, many years. We trade options in the billions every day. So it's kind of like the bread and butter of what we do. So we build these ETFs, and then what happens at the end of the outcome period, which can be up to a year, is that we just reset the package. So if you're riding the market up because the market is up, which happens to be the case, 7 in 10 times, give or take, then you can reset the buffer at that new level. So if you start with $1 million, the market is up 10%, you have $1.1 million. Now you get a new fresh buffer under the $1.1 million, and you can keep riding the market up to the next cap for the next 12 months, let's say. So that's just a very quick primer in terms of how they work. And I can spend the next 30 minutes on the topic, so if you want to hone in or cut me off, please do. But the beauty of this is that it's a very versatile product, and we can get into this if you want to, but you can think of this as a way to de-risk equities if you have clients that are closing in on retirement. You can look at this as re-risking or going higher up on the risk spectrum if you're moving from more conservative investments, whether it's fixed income or some kind of alternative. You can look at this as a diversifier to your portfolio. When you're constructing it, you have alternative assets or liquid alts that can get pretty complicated. So if you don't want to have those complicated conversations with your clients, you can swap in something that's pretty simple in its construction. You have a cap and a buffer, and I can tell you exactly what to expect based on what you think the market's going to do. There's no gimmick behind it. It's a structure that's been put in place. And then, of course, it can help motivate cash to get off the sidelines, for those that are fearful for getting into the market. And we all know the story about how much cash there is and, so on and so forth. But I'll pause there because I don't want to overwhelm too much with this. But it's a really cool product.
Yeah, that was an interesting primer. And you talk about them being, similar to like a structured note. And so, I'm curious, when you think about home offices, whether it's at a wirehouse or a regional broker-dealer, an independent broker-dealer, many of those offer structured notes. That's actually a revenue line for them. And so how is the reception when you think about home office approvals here? Because you're essentially competing with potentially another revenue line that they have at that firm.
Yeah, they've made that clear. But there is also a very wide span of receptivity, and some people are early adopters, and others, they want to take their time. So the long and the short of this is that some home offices, they just say, well, cool, we have some requirements, we'll put you on the shelf and we'll see what happens, right? And then you have others, to your point, Johan, thanks for coming, but we have other things to do, right? Yeah. And you kind of you can read between the lines, or you just read the lines, and it's right, it's pretty straightforward. But what happens is that over time, and coming from an insurance-owned company, we were treading through this ourselves internally because, will these products compete with our own core business? So trust me when I said that they had me over the coals many, many times to figure out whether we were going to cannibalize or not. And to make a very long path very short, the answer came back and it was no. It's just opening up a new market opportunity. And the same, I would argue, is true for the structured notes business. We happen to be one of the major investors in a structured notes business ourselves, so we have pretty good insight into it. And it's a different buyer. Somebody's buying a structured note, they typically have a pretty specific investment objective. They might have something on the other side that they need to hedge out, or they're looking for something that can be illiquid for the next 2 years, or whatever it might be. ETFs are liquid vehicles. Yeah. You can't do the same thing that you can either on the insurance side or on the structured note side. You just can't. There's no illiquidity premium in ETFs. But the broker-dealers and the home officers and their gatekeepers, they're basically one by one starting to realize this and the pressure is strong enough from the advisors pushing up, asking for it, because not every client needs a structured note or an insurance product. They just need to have their money invested at the risk profile that they're looking for.
Sure. I think it's interesting, to talk about them coming around and this new opportunity. I can tell you from State Street's perspective, when we think about these products, we can't help but acknowledge that the underlying exposure for many of these are products like SPY. And when we launched SPY 30 years ago, this was a use case that nobody that was part of that launch had ever contemplated, that they would be the underlying exposure, for this new category of ETFs. So really fascinating. I want to move on to really another area of growth for the industry, and that is fixed income ETFs. And Jill, I got to come to you here. There has been a ton of ink spilled around fixed income markets, and obviously last year was an incredibly challenging year. It was, this period of time when the Fed raised, the fastest and the shortest period of time, in 40 years. Investors in fixed income last year got hammered. The AG was down 13%, but the calendar page turns, and this year fixed income is in the headlines for a different reason, and that is because the income component of fixed income is front and center. Investors in bonds are finally getting something that they haven't had for a long time, and that's income. And we can't help but notice it playing out in ETF flows. So year to date, there's 130 billion in inflows into fixed income ETFs. So that's 43% of the 300 billion that's come into ETFs this year in the United States. So well above historical averages. So Jill, I'm coming to you. Is this a new era for bond ETFs? How do you see this playing out? Where do we go from here?
Yeah, so I wish I had a crystal ball, but there's a lot of reason to believe that we're in a space right now where fixed income ETFs are going to continue to play a bigger role. So you got us to the cash flows that we've seen this year, but just to throw out a couple of other headlines around fixed income ETFs, since 2012, they've had about a 23% per year growth rate, which is wild. We all wish we had that in all of our products. There are about over $1 trillion, well over $1 trillion in fixed income ETFs right now, and about 600 different options available for investors out there who might want to use fixed income ETFs. And when I think about that, there's just a tremendous amount of reason to believe that we're going to see more flows in that space in the years to come. So we're banking on that.
And maybe, if you believe that we're going to see, flows in fixed income, just for the benefits of the audience, why do people use fixed income ETFs versus just buying individual portfolios of bonds?
Yeah, sure. There are probably realistically about 8 reasons I could list, but I'll keep it to 4 simple ones for the audience here that I think are the most impactful, the biggest reasons to use fixed income ETFs over individual bonds. The first one, and you've probably heard Vanguard say this one before, diversification. Just having a bigger basket of bonds that you're investing in can provide benefits if there's individual issuer risk or individual risk with one particular bond for any reason. So first is diversification. Second is price discovery. So fixed income ETFs are issuing prices all day long. So all day long, you're able to see accurate prices for fixed income ETFs at times where if you're holding an individual bond, you really might not know what it's worth at any given time of the day. The third on my list is liquidity. I think this is one of the key benefits of fixed income ETFs and why people should be holding them. In addition to being able to see those prices, you can actually sell them. If you have a bond in your portfolio, a single bond, you may not be able to actually liquidate that at the time that you need to. So great for cash management, great for a liquidity sleeve of a portfolio for some of those institutional investors. And finally, I think the other big one is that you know what you're getting. You know exactly the exposure that you're getting. You know the exact characteristics that you're able to represent. So it's a little bit better for portfolio allocators and builders to put it into their portfolio with that knowledge that they know exactly what those characteristics are going to be over time and that they're going to hold steady.
Got it. Okay, so we've talked about defined outcome ETFs as a major area of fueling the growth. We talked about fixed income and really kind of the eye-popping flows we've seen there, way above their historical averages. I want to come to you, Cleo, around active ETFs. And Johan did a really nice job of walking us through the ETF rule and really how that has made it easier than ever for new entrants into the ETF market. It sort of reduced barriers to entry, made that path less uncertain, provided guidelines, and as a result, we've had quite a few newer entrants into the ETF market. Many of them have been active managers, and so 77 billion out of the 300 billion that I mentioned have come into ETFs have been in active. What we think is interesting is we see it in a number of different ways. We talked about how you've got mutual funds that are actually just converting into ETFs for tax efficiency. You also have newer entrants into the market that have historically been active players and are saying, we're going to join the ETF party, think a capital group. You've got long-standing ETF providers who are electing to hire active sub-advisors. That's what we do at State Street. We hire in the fixed income space really great active managers like DoubleLine or Blackstone or Nuveen to run our active ETFs. And then, you know, we've also got we've talked about the conversions, we talked about the new entrants, and then, you know, you've got people like BlackRock and Invesco who are just launching new ETFs from the active side of their business. We saw earlier this week there was a headline, there's going to be, you know, Rick Rieder is going to run an active ETF fund now. So lots of different ways that we're seeing active ETF flows. And so that being said, it's fascinating to me that active ETFs only represent 6% of ETF assets today. But we've got the ETF rule, we've got sort of the path cleared, and we've got quite a bit of momentum in the active space. So Cleo, I'm coming to you. If they only represent 6% of ETFs today, do you think that that will persist, that sort of discrepancy? Or do you think there will come a day when there's more of an even balance between active ETFs and then the traditional passive strategies?
That's a great question. And I think this is what draws me to the ETF world so much, is the innovation and how fast the adoptions are. I'm sure many in the audience saw this chart where they said it took Instagram like 9 years to reach 1 billion users, and took ChatGPT like 9 hours to reach 1 billion users. And I think that's what we're seeing in the ETF space. Because of the groundwork that was laid by State Street and other early entrants in the ETF space, ETFs now is a well-accepted wrapper in the industry. So for innovation to come into the industry, the adoption is much, much faster. I think very similar to kind of the Instagram versus ChatGPT curve. You're just seeing a completely different ramp-up curve. And even though active ETF assets only represent 6% of the AUM, active ETF really only made it onto the market in a meaningful way, maybe about 4 years ago. And we're really happy that American Century was the first to bring semi-transparent active ETF to the industry. And I think more notably, Avantis Investors, who is this hybrid between passive and active, right? The best of both worlds, diversified, but opportunity to generate alpha at a very low cost type of approach. And we actually launched that before the ETF rule came into play. That has really changed the dynamic of the marketplace. So I think if you think about we went from essentially 0% of market share to 6% in a blink of an eye. And you know, I think, Allison, you quoted the 77 billion. In August, active ETF represented 68% of flows into the ETF space. So I think you are just seeing this very, very rapid adoption. There's still a lot of ETF users using passive. It serves a really, really important role in both retail, intermediary, and institutional portfolios. But I think with the innovation and the entrance into the active ETF space, we're going to see that ramp up, sort of the Instagram ChatGPT curve. And every month we're seeing data that validates that trend being the case. So we're very, very excited.
So that's the active standpoint. And Jill, you know, I'm going to come to you, see if you got a counterpoint. You know, from Vanguard's perspective, you know, traditionally we think of them, you know, passive. What do you all think about this growth of active, and how are you thinking over time, you know, this will play out?
Yeah, so actually, we are very well known for passive, but many people don't know that actually a third of Vanguard's assets are actively managed. So surprise, surprise for some people, but those who know us well actually know that we have some active ETFs of our very own, both in the equity and the fixed income space. So earlier I mentioned our factor-based ETF strategies, which we did decide to do in an active framework so that we can keep very high exposure to the factors that we're intending to approach with each one of those products. And we also have an actively managed ultra-short bond ETF that we launched to market that's been a wildly successful product of ours. And so, despite our reputation as a passive manager that I'm still very proud of as a Vanguard crew member, I do see us looking opportunistically at the active ETF landscape and seeing where we might want to play there. It's still going to be probably broad-based exposures. It's still going to be those core building blocks most likely, but I do see a place where we would be pretty bullish on the case for active ETFs as well.
Very interesting coming from Vanguard. Okay, the last kind of product segment I want to cover, and then we're gonna talk about some other kind of provocative things. The area of growth I want to talk about is thematic ETFs, and here we are at Future Proof. Very appropriate that we'll be talking about thematics. I think thematics became kind of on the forefront of people's mind when ARK came to market, but it's interesting over the last several years we've actually seen ETF providers, large and small, launch thematic ETFs. This year, the specific theme that seems to be resonating the most is around AI, robotics and AI. I don't think that's a surprise when we sort of think about the potential transformative nature of generative AI, how people are using ChatGPT. But I want to kind of get the panel's take on thematic ETFs. Are you bullish on thematics? Do you think it's a fad? Within the specific thematics space, do you think, these robotics and AI ETFs will continue to kind of lead the way, or is there, other themes that the audience should be thinking about? So Cleo, I'll come to you.
Well, I think any innovation just brings a lot of excitement to the ETF space. I think we welcome all of them. At American Century, at Avantis Investors, we believe in thematic investing, but we believe in more secular themes. So currently, we don't have an AI or robotics kind of themed ETF, but we do have focused dynamic growth, which really focus on growth companies that are at that breakout stage. And we've been running that strategy for almost 10 years now. So I do think thematic investing has long been part of the investment world. Kathy Wood was doing thematic investing prior to ARK for 20 years. So we were always, at the time, we were an early investor in that thematic investing. So I think that's going to be around for a while. Inflation kind of oriented strategies has been a thematic product, has been around for more than 20, 30 years. And then I'm not talking about tips, right? I'm talking about kind of inflation oriented portfolio. So I think thematic investing covers a broad spectrum of strategies. American Century and Avantis will likely focus on more secular themes. And we may have some exposure to AIs and whatnot, but I don't think this is a space we're going to go into on kind of the topic du jour. But I do think there are some very qualified providers who can bring that kind of product to the marketplace.
Got it. Okay. Well, now I want to talk about, something that every investor really seems to be hyper-focused on right now, and that is cost. One of the hallmarks of the creation of the original ETF SPY 30 years ago was this notion of low cost and the idea of democratizing investing and leveling the playing field. And it shouldn't matter how many zeros you have in your portfolio. You should be able to access really great investments. But boy, does it seem like people are really hyper-focused on expense ratios right now. I know at Spider, we tend to focus on the total cost of investing. The expense ratio is one component of that, but you want to think about other, considerations like the cost to transact, to get in and out of an ETF, tracking error, all of those things. But I feel like a lot of people just look at the headline expense ratio, and maybe that's because that's what's most visible. I know that we are responding to it at our firm. We just lowered expense ratios on 10 of our core low-cost ETFs. We now offer S&P 500 exposure for 2 basis points with a product SPLG. So we are responding to that. Jill, coming from Vanguard, a pioneer in low-cost investing, my guess is this is music to your ears. But I have to ask, do you think that there will continue to be this hyper-focus on just expense ratio? Do you see sort of this downward cost pressure persisting?
All right, so yes, perfect question for Vanguard. I think we started to sort of lead the long train of people that are coming after us trying to lower costs in this space. And of course, we're a huge advocate for it, and I believe our advisors that we work with are the biggest advocates for it, because in reality, when they think about their costs that their investors incur, they have our expense ratios of our investments, but they also have their advisory fees. And funny enough, advisory fees have actually not come down over the last 20 years. So advisory fees 20 years ago were about 1%. Advisory fees now are about 1%. So they're looking to compress those costs somewhere. And we, the ETF providers, have been able to do that for them. We've been able to provide that to them. So I think overall, it's a good news story for everybody. But 10 years ago, when you were looking at an ETF, if you were assessing whether you wanted to buy an ETF, you could see differences of, all right, one provider is 20 basis points and another is 10. I've got an easy choice in front of me. Well, now when we're talking about 2 basis points or 3 basis points for the S&P 500, the choices start to get a little bit more confusing, in fact. And so what we're seeing now is that folks who are looking at ETFs for their portfolios are having to think differently about how to make investment choices. So it used to just be cost. Now they're starting to have to look under the hood at their ETF and say, well, what kind of securities lending program does this company have? Are they returning the revenues that they make from securities lending back to shareholders? Are they mitigating risk in the way that they do that? They're also having to look at the exposures that are given. Are there pure exposures? Are they sampling? Or are they actually holding the full representative index and tracking really well? And third, and probably among the most sort of difficult ones to decipher is really what other value-added trading is that company doing. So I look at an example of when the S&P 500 was going to or not going to add Tesla to the index, and Allison, you probably remember this well. But when the S&P 500 adds Tesla to the index, it all happens on one day. But providers who are smart, like Vanguard and Spider, can actually look across multiple days and make those trades in a way that's beneficial for our investors. So Vanguard, for example, made about a basis point of extra expense ratio back for the clients during just that one trade. And so I think that the likelihood to now have to open up the hood, look underneath, and figure out what's inside your ETF and who's trading it and how are they doing it has just become even more important. And so it's a whole new challenge for investors.
Yeah, I couldn't agree more. And Johan, you are not immune to this. I couldn't help but notice that BlackRock, when you're not first or early to market, a lot of times providers will launch and come in at a lower cost. And so BlackRock has entered the ETF market, coming in at a lower cost. How are you all thinking about that in that defined outcome or buffered space?
Yeah, yeah, sure. So there are a few things there, I guess. Number one, it's a free market. So the buyer will dictate where the price point is and how much they're willing to pay for any product. You spend more money on a Gucci bag than a bag from Target, right? It's like for a reason. But not to be too flip about it, but that's the reality. And the pricing will follow based on the demand and supply like anything else. And then the competitive nature between the different firms. And it's based on the product. And then, of course, in the active space, and we're talking about active ETFs, they're still priced, 100x what the passive products are, right? For a reason, because it's expensive. You have people in the background, you have systems, it's not free. to manage money, right? So I think that's the baseline. And then it always comes with price and scalability. So whoever gets to scale first has more pricing power and staying power as a business, but it always shrinks the margin. So how much do you want to shrink? Well, it depends on how much you want to pay. That's always the case. So it's simple market economics for the asset management industry as well. So that being said, to your question about BlackRock coming into the defined outcome space, they have a different type of product. So the question is, what do you want to pay to get a very specific defined outcome that you can understand when you put it into your client portfolio? And how much are you willing to pay for something that you can't really tell exactly what to expect from? There's a very different price point for the S&P 500, for example. You know you're going to get the S&P 500, but you have, for the most part, no idea what that number is going to be 6 months from now, right? Or you can buy a minimum volatility S&P product. You don't really know what to expect, and there's plenty of times where you got surprised as well, right? And the list goes on. Risk parity, pick your pill, right? But if you're willing to pay for a structure that you can rely on, then that's great. You take it or leave it, right? It's a binary decision-making point for any investor. I like it or I don't, and the price is okay. But the trick is, of course, in this industry, and it's actually a really crappy industry to be in from a pricing point of view, because it's a one-sided coin. You can never increase prices. They only go down, So anything that's new is going to find that limit, like how high can the price be? And then over time, yeah, it will go down. The only question is how quickly.
Yeah. Anything you'd add, Cleo? Again, I think people think of ETFs, and because historically they've been passive, as ultra low cost. But on the active side, obviously that's a different value proposition. Is there anything you'd add there around this kind of hyper focus on expense ratio?
Yeah, as much as State Street, Vanguard has been pioneers in providing low-cost investment vehicles to investors, I would like to include Avantis investors in that camp. So 4 years ago, as Avantis investors entered into the ETF marketplace, we brought price disruption to active ETFs. So if you look at the 20 plus Avantis ETFs on the markets today, you will find them to be incredibly attractive from a fee perspective while getting active management. So we live in a very, very volatile world today, right? I'm going to take you back, way back to March of 2023. I know it's hard to recall what that was like, but that was the mini banking crisis that we were going through. Imagine if you were in a passive ETF. How often do the index get reconstituted? Once a year, twice a year, and if you're really lucky, maybe 4 times a year. Well, for you to really manage around the exposure you now don't like because we have a mini banking crisis, you got to wait until the next index reconstitution if you're in a passive product. The value active managers can bring to your portfolio is we can take the latest information in the marketplace and make what we believe to be the optimal investment decision for investors today. We don't have to wait for the next rebalance or reconstitution. And the trade-off for that historically has always been the price gap that investor would have to fork out every year for that. So Avantis investors disrupted that pricing dynamic by bringing passive-like fees to actively managed products. So I think, as we look back, and that's what I hope to do in 30 years, I can be sipping my tea in the morning and I haven't to be in this business anymore. I like to think Avantis investors changed the investing world for investors for the better. And we're going to be remembered as a State Street, as a Vanguard, where we brought active management to every investor in every client segment at a price point that makes active management make sense. So I'm really excited about that.
I love the passion. Okay, we talked a lot about the growth, but anytime you have an industry that's grown like this, new players in the market, new categories, at some point you're going to have closures. And on a year-to-date basis, we've seen 173 ETFs close here in the US. And so I just want to get kind of your hot take on that. Is the market becoming oversaturated? Are we kind of good on ETFs and ETF providers? Or would you say, no, Allison, this is a natural kind of outcome of an evolving market? So Jill, I'll start with you.
Yeah, I actually love to see the innovation that's happening here, and Johan mentioned it earlier. There's been some regulatory environment and some difference in the price to launch an ETF that's just created an allure for folks who want to be in this business. And I like to see it. Unfortunately, though, I believe the closures are going to persist. I mean, we had 120 closures last year. We're already at 170 some this year. And so I think that unfortunately, the flip side of that coin is that the closures are going to persist. So a couple interesting ones that popped up on my radar recently that 2022 brought us were the inverse Jim Cramer ETF, the meme ETF. I mean, the limits are endless as to what will be out there, and it's nice to see investors getting a lot of choice, but the reality is they aren't always sustainable investment themes or theses, and so I think the closures are certainly going to persist. At Vanguard specifically, when we look at launching new products, the reason we don't go into a lot of these very esoteric or small parts of the market is we're client owned. When we go to our investment committee, we're really looking for enduring investment themes that will be around in 40, 50, maybe even 60 years from now. And I think it'll be really hard to see a lot of these new entrants play out in the future.
It'll be, go ahead, Johan.
No, I was going to say I like it. It's so. Full disclosure, grew up in Sweden and came to the United States for a couple of reasons, but one of them is the American spirit. And you see things launch, you see them close, you open the door, you shut it down, you try again. It's the way it should be. So I think it's a healthy environment, even if you see things close down. It's no different than any other industry. You have a lot of newcomers, small entrepreneurs that give it a best shot, didn't work, come back, try it again. It's perfectly healthy.
Yeah. Well, you can't have innovation without some failure. That's sort of the definition of it, right? In our last remaining minutes, I'm going to ask a couple of lightning round questions. So we've talked quite a bit about what's happened over the last 3 decades and how ETFs have grown and really changed the investing landscape. But despite all of that, ETFs today represent only 9% of investable assets. And so my question, and Joe, maybe we'll go down the line starting with you. If they only represent 9% of investable assets today, where do you see that percentage being in 5 years?
I'm not going to speculate on exactly where I see that percentage, but I will say that one of the things we're doing is we're very closely following what could be the factors that could influence that percentage to be way higher than 9% or just a little bit higher than 9%. And so a couple things that we're looking at that might inform where this is going to go. One is the 401k market going to get into the ETF space? Can you believe it? We've had ETFs for 30 years now, and still the 401k market has little to no access to ETFs. We're thinking about how direct indexing might play a role and how ETFs might become an extension of direct indexing. If that plays out, we should see a tremendous amount of growth in ETFs. And third, I think as far as ETFs go, there's a lot of still people who may want to transition existing mutual fund lineups or SMA lineups into ETFs. And certainly if we see that continued trend play out, that delta is going to be really high from 9% where we are today to where we might be in 5 years.
Johan, what's your take? Joe wouldn't give us a number, will you?
12.
Okay. Easy enough. And then what about you, Cleo?
Yeah, I think this is one of those things where investor behavior and preferences don't go backwards. So I'm an Amazon Prime member. I get everything next day. I am not going back to another Amazon 2.0 that tells me I can have my package in a week. Investors just don't go backwards on their preferences. So when the newer generation have only known that they can trade ETFs throughout the day, they can get price transparency, they have the structural advantage of ETF over mutual funds, unless they are forced into a mutual fund, say, as part of their 401k program, they're not going backwards. We don't go backwards, right, in life when we make choices. So I think what we're really going to see is that generational build their wealth they're going to be the inevitable driving force of ETFs becoming only a bigger part of the market share. And then depending on how institutional clients around the world and financial intermediary around the world adopts ETFs, I think that number can only get higher from here. But I really think about just the investor behavior. People don't go backwards. And that's what I think is going to drive growth in ETFs in the next 20, 30, 40, 50 years.
Wonderful. From your lips to God's ears. So, we're up on time. I want to first of all thank all of the panelists today. I think this has been a really robust discussion from a handful of the leading ETF providers in the industry. On behalf of women in ETFs and the 9,000 members of women in ETFs around the globe, and specifically the newly formed Southern California chapter of Women in ETFs. Thank all of you for joining us this morning, particularly probably after a late night and showing up bright-eyed and bushy-tailed. I think I can speak for all of the panelists when I say after 30 years, it's unbelievable to see all of the innovation in ETF, all of the benefits, all of the better outcomes that the industry has created for investors. And I think we can't wait to see what the next 30 years looks like and how much better outcomes we'll all be able to drive for the entire investing community. So thanks again.